morning to you, karibu sana, and this is Money Monday. That is your go-to show for financial tips, great insights on how you can become a successful entrepreneur. We give you strategies, and also as a day-to-day person, make sure that you get to become financially independent in the future. My name is Angela Kabete. Don't forget you can interact with us on our social media handles, that is on Facebook and YouTube at Mizpah TV Kenya, hashtag It's Money Monday. You can opt to use our WhatsApp number, that is 0799200100, and we'll be so glad to hear from you as we learn today. Since we're talking about that is an interesting topic, that is cash flow mistakes that entrepreneurs make and what auditors see behind the numbers. So basically get to understand what are these pitfalls, what are the mistakes that you make even as a day-to-day person, because cash flow management is something that is really important. And according to the global perspective, that is the statistics, they say that 82% of small businesses fall within fail because of cash flow problems. And that's not just poor accounting, it's often internal controls, late reconciliations, and lack of oversight, the very things auditors flag every day. Meanwhile, the top firms like Microsoft, Apple, Alphabet, Google are sitting over that is $2 trillion in cash reserves, and billionaire like Warren Buffett believe in keeping cash as a shield, not as a decoration. Today, we'll uncover what auditors see behind the scenes and what we can learn from it. And that's why today in studio I'm joined with an experienced guest. She is an auditor. Her name is CPA Mary, and currently she's the head of internal audit at Nakuru and Sanitation Company. Without further ado, help me welcome her to the show. Very good morning to you.
Good morning to you, Angela,
and
thank you for having me today. I'm doing well.
You're well?
Yes, I am.
The last time you're here, it has been long, but finally you're here today.
Yes, I'm back, and I'm glad that I'm back, so that we can help our people.
Yeah.
Yes.
Happy Mashujaa Day.
Happy Mashujaa Day to you too.
And today we're talking about something that is really interesting, that is the cash flow mistakes that companies make, the business people, and even the day-to-day people. And last week, I understand that we defined what is cash flow. That is from one of the financial advisors that we had. But today we want to hear from an auditor's perspective. What exactly do you define cash flow, and why does it matter so much to a company?
Yeah, thank you, Angela, for that question. As auditors, we give assurance of processes, internal controls in a company or a business, and it is a continuous process. And for us, cash flow is not just movement of money in and out. For auditors, we look at cash flow as the lifeline of the company, because accountants will want to show us what is on the paper. We did these sales, this is the expenses we paid, and this is the profit. For us, we don't look at the profit, because as it was explained, you could be reporting profits, but you don't have the real cash.
Okay.
So cash is the lifeline of any business. We need to see, are you able to convert those sales into real cash, so that you can be able to meet your day-to-day obligations. So for us auditors, we look more into the cash flows, not into the profits, because we know there are things we call creative accounting. So people will be reporting fewer expenses than they are. They will delay them. They will say they are delaying to report those payments into the financial statements. So it will look like you had more sales and less expenditure, and then a very huge profit.
Yeah.
But in real sense, is there cash in the bank? So we are interested in the cash flow. You did your sales, probably majority were on credit, but did you convert that credit into real cash? And like you have quoted Warren Buffett, that, you know, cash flow reserves is what drives a business. And for people who are getting into business, if it is a startup, you must have some reserve. There's something we call burn rate. Burn rate means that there is some money that can run that business until it is able to sustain itself. Because when you're starting off a business, you do not expect that business is going to pay rent for itself, pay staff for itself. So you must have some reserve.
Apart from the capital of starting the business?
Yes, you must have some reserve. If possible, at least 3 months to 6 months reserve. That means you have reserves that can pay all the bills for 3 to 6 months, to be sure that when as your business picks up, there is some money to run that business. So it is very critical to have cash, reserves, and good cash flows coming in. Yes.
And there's something that you have mentioned, and it sounds so interesting, that a company can be making profits, but at the end of the day, your profit hakuna in the reality. What could have happened in between?
What could have happened is probably you're selling goods on credit, or your services. If you are a consultant, you go offer your consultancy on credit. But in your financials, as long as you earned, earning means you were contracted to go give that service, or you sold those goods on credit, you will report as sales or as revenue.
Whether it's credit, it's still a sale, right?
So it will be considered as revenue. But in the real sense, you have not received that money. So if you are not able to manage those credits, that the madeni, and convert them into cash, your P&L, profit and loss account, will look like you have a lot of profits. But that money is out there with people. So that is why we are also saying it is good also to manage debtors. Debtors ni hawa watu wako na madeni yako. If you don't manage them well, your bills or your liabilities will be falling due. For example, you are required to pay salaries. You're required to pay taxes that are falling due. But your money is out there with people. So your liabilities will be falling due while your money is out there with your customers. So you will fall into a financial crisis. And you can even end up being, put under receivership if you cannot be able to meet your day-to-day obligations.
Wow. And then let me connect that with this question. How does that is the weak internal control or lack of documentation affects the company ability to manage cash flow?
Indeed, if an establishment or a business or a company has weak internal controls, it means in the side of recording, if you are still using manual way of accounting for your finances, chances are people will see those weaknesses and find ways of getting money out of your business. Because you're not able to track. And that is why where we are now, there are so many softwares or financial management systems that can be customized. You don't even have to go get the large scale financial management systems. You can contract someone to come and look at your business and advise you and work within your business. If you're into hardware, they will look at what items you're selling, how do you do it. They can come up with a system for you, so that you remove human interference. We say, humans, that is why there are laws. They want to flex. So if you allow them to flex with your finances, they will find a way. So internal controls, for example, if you have a cash flow, you have projected, this is how I'm going to raise this money, my sales, I'll be collecting this money this way, I have my debt collection team. You must, in your internal controls, you must find a way of tracking. If we sold on credit, is there someone who is tracking? So that you don't overstretch your credits. You gave someone a credit of 90 days, it is over, and no one is following up.
And still you count that as a sale.
And it's already a sale. But it has not converted into cash. So we look at such kind of internal controls. Make sure you're following up on the debtors. If it is your team that also, because as also a business, you also get goods on credit. We would advise as internal auditors, do not be quick to pay. you can free up that cash to either bring more stock and sell more than...
Yes. Kindly repeat what you've just said. Do not be quick to pay.
Do not be quick to pay. Here, it's a dicey kind of a situation. Okay. When they sell to you on credit as a business, and they give you, say, 90 days to pay, don't pay on the first day.
Why?
You can free up that cash. For the 90 days that you have been given credit period, you can use that money to bring more stock and turn it into more cash. But for you, if you sell on credit, make sure you follow that money immediately.
Okay.
That is how you have converted your sales into cash. But you delay paying your suppliers and use that money to turn into more cash. Because you can even fix that money for a month or two and earn some interest. So it's a balance. Make sure you're benefiting from credit facilities, but you're pushing your customers to pay as soon as possible. Yeah.
Wow, I love that. Is something that every business person should take to the bank. Sure. It's very, very wise, because most of them unapata kama akona deni, punctuality the first day ako hapo kulipa. But madeni iko mingi.
Yes. Yeah. It is good to free up that cash. Free it up. Do some other things before the 90 days are over. That money will have earned you something. Yes.
And you, as an auditor in your area of expertise, what is that one key indicator that you see often during auditing that signals that the company might have a cash flow crisis?
We also look at payables. When especially when we are closing a period, say a quarter or a financial year, even if they were underreporting expenses in their day-to-day operations, at the end of the year or at the end of the quarter, they will report payables. Payables are all obligations that the company has not been able to pay. So we look at that. If we see the payables are going up, it means that company is not able to meet its financial obligation. Another thing we also look at is the increase, the changes in debtors. Debtors ni wale watu wako na madeni yako. It means you're not aggressive enough to go collect your debts. So we also look at that. If they are growing at a substantial rate, we can tell that your team is not aggressive enough, and therefore all your cash is out there with your customers. So we look at those two, the debtors and the payables. Yes.
Okay.
Yes.
And what about, does that apply only for the companies or even for the small SMEs?
It applies for both. It applies for both because the concept is the same. Even if you are a small SME, assuming you're just an individual who is offering consultancy services, you might not have an internal auditor, but you as the proprietor of that business, you should be able to be tracking your cash flows every day. For example, I gave a consultancy service last month. 2 months down the line, I still haven't been paid. It shows their debtors out there. Debtors zangu bado zinaenda juu. So I look like I have money, but at the end of the day, my money is out there with the people. So the concept is the same. It is just on the, you know, the magnitude at which it is happening. If it is companies, they can afford to hire internal auditors. So we will be there every day giving that assurance and checking whether the company is still sustainable or the going concern is threatened. Yes.
And there are issues that you have mentioned, like delayed invoicing, poor expense tracking, unverified petty cash. Can they lead to serious liquidity problem in a company?
Yes, they can. How? For delayed invoicing, you sell to people on credit, but you don't invoice them. For example, if I sell to you this cup today, but nakudai 3 months later, that is late invoicing.
Okay.
It means I'm not in a hurry to convert the sale I did into cash. And when I don't have real cash in the bank, I will not be able to meet my obligations. From where am I going to get money to pay rent, to pay salaries, to pay taxes? Yeah, so all those issues that you've mentioned, as long as cash is not flowing in, they will affect, you know, liquidity is that cash.
Yeah.
So if the cash is not coming in, then you cannot be able to meet your obligations. Yes.
Okay. And still, let's talk about that is the world of business and the entrepreneurs. Most of them, they mix that is personal cash and business cash. Does it affect that is auditing and also transparency in the business?
It does.
How?
It does. And we encourage, you know, if you are running a business, even if you are a sole proprietor, it is encouraged that you give yourself a salary.
You pay yourself in the
Pay
business?
yourself a salary, so that you get out of this temptation of picking cash as you wish. Oh, I'm heading home, so give me 2,000 from the cash box.
I have an emergency.
I have an emergency.
Yeah.
You're supposed to operate as a staff.
In my own business?
In your own business. So that you can be able to tell whether this business is sustainable or not. So we encourage you separate your personal finances from the business. Even if you are running that business as a sole proprietor, pay yourself a salary and operate like everybody else. If you're going to recruit more people, let the financials of your company show that we earned this money, we incurred this in personnel emoluments, that is the salaries, we paid rent and we did all this, so this is our surplus. But if it is all mixed up, even reporting would be a challenge, because you don't know how, I mean, even surrendering, if it is the director who owns the company, they take money,
When
they don't
want.
surrender that money, they don't say how they spent that money. Then in terms of, even if you are to bring an internal auditor to audit that company, they will not be able to track, because you have also mentioned about tracking expenses.
Yeah.
If you just take money anyhowly and you don't surrender that money, it will be very difficult even to audit that establishment. Yes.
And there's something that you've mentioned, that is tracking how you spend your money. So even if I'm the sole proprietor in the business, I'm supposed to track each and every coin the way it's spent. Is that what you're saying?
There's someone, there's a book I read, and that person said, tracking your expenses, even the richest, even the billionaires track their expenses.
Yeah, that's true.
If you don't track your expenses, it's like starting a journey but you're not sure where you're going. Even people coming here sometimes use Google Map because they want to track
Where they're
their
going,
movement so that you reduce on wastage. And tracking comes with a budget and cash flow forecasting. You know, for a budget, it helps you to cap expenditure.
Okay.
It tells you, I had budgeted to buy this camera at 200,000. So if someone wants to go there and tell you, no, this camera, I can get it for 300, you know your budget allows for?
Only 20,000.
Even if they want to increase the specs, you know, you're telling them, the budget I have for the camera is 200,000. Cash flows forecasting. If you do not put a cash flow forecast, you don't know when you expect money. So you will not even know how to plan for that money. So tracking is both ways. You must have a budget and you must have a cash flow forecast, so that you know if this money comes, I'm spending it as per the budget. And even if it's a sole proprietor, like I was explaining earlier, you must have a budget so that you don't, when money is good, if you are a consultants probably in a certain period they get good business. And in some periods it shrinks, because it depends on, like in government, there are months there is no money. The financial system is closed, if miss. So from maybe July to September there is no inflow of money coming. So if you are depending on government to give consultancy, within that period you're not earning anything. So if you did not plan your finances, you did not have a budget to tell you, if I'm going to buy this car, and this car I wanted to buy it in July, and that is when the cash flows are very low, then your forecasting is not going to work. You must look at, when do I expect to get money, and then how do I spend it. So tracking your expenses, you must start with a budget. Otherwise, you cannot track expenses that were not budgeted for.
Okay.
Yes.
So that sounds interesting. I will go for a short break. Then when you come back, you'll help us understand. When we're doing the forecasting as the entrepreneurs, as a day-to-day person, can you still get yourself making a mistake on the same area? And then when you come back, I get to compare what the billionaires and these big companies, what they're doing, and what the small SMEs can take from that. So for our viewers, make sure that you stay tuned, and also you can interact with us on our social media handles, that is on Facebook and YouTube at Mizpah TV Kenya, or you can opt to use that is 0799 200 100. Tell us, what have you learned in this session? Stay tuned. We'll be right back after the short break. And welcome back. This is Money Monday, that is your go-to show for financial tips and strategies on how you can become a great entrepreneur. And for the day-to-day person, make sure that you get to become financially independent in the future. And today, on this edition, the second edition of Money Monday, we're talking about that is the cash flow mistakes that you make as a day-to-day person, as a company or entrepreneur, and you give you the solutions and the strategies on how you can make it better so that your company can work well. And I'm not alone. I'm back with my guest, that is CPA Mary. Welcome back.
Thank you.
And I love the way you helped us understand what do we mean by that is cash flow from an auditor's perspective. You gave us the strategies, the red flags when it comes to cash flow management. That was really nice. And now on this session, this second session of Money Monday, let me start. When you look at these top companies, those companies like Apple, Google, Alphabet, Microsoft, that hold billions in cash reserves, what are the lessons that small companies should take from them?
Thank you, Angela. And looking at those companies that you have mentioned, and of course they were not built in a single day.
Yeah, I agree.
One thing you'll agree is that these companies have multiple sources of, revenue streams.
Yeah.
You've mentioned Apple. Apple will sell phones. It has software services.
Yeah.
You look at Elon Musk. He's into space. He owns Starlink. I mean, you must have multiple revenue streams.
Okay.
These are also companies, if you look at their financial statements, their reserves are good. I mentioned earlier about burn rate, it's for startups.
Yeah.
But for continuing, businesses, you must also put aside some reserves. When you make your profits, even if it is a company that is issuing dividends, you must put aside some reserves. And these reserves are to help these companies in case there is a financial, crunch. Like when COVID came, there are companies that had to downsize or, drop some line. Exactly. So those reserves are to come through in case there is such kind of financial crunch. So basically, for the large companies, you will see they deploy even financial management system, which the SMEs probably are struggling with. Maybe you're still recording your cash book manually, but these large companies, to be able to track their day-to-day operations, they have embraced technology. So I would also advise the SMEs, and I had said this earlier, you don't have to go for these big financial management systems. You can contract someone to come and do a smaller version of it, so that every day, because the trick here is to also monitor your cash flows, either every day or every week or monthly. But if you're still doing the manual way of recording, it will become a challenge. So what these large companies have done is embracing technology. Like I have given you an example of Elon Musk and the Starlink. They're saying as long as you have purchased that equipment, it is free internet for life. Yeah. So these are people who are also being innovative in the way they do their things. So for small businesses, don't just look at, I sell books, that is all. Yeah,
that's all I'm selling.
That is all I'm selling.
Yeah.
You can look at those books and what else does it marry with. Maybe if you sell books and sell uniform, the parent who came to buy books will buy uniform.
Yeah.
So you must find ways of having multiple sources of income. Even if you are a farmer, if you are doing dairy farming, why don't you think of also doing hay so that you don't have to buy from other people to feed your cattle? Yeah?
Yeah.
I mean, people who are successful, even in Kenya, let's not even go far. The Moi family, these are people who are into every sector.
Yeah, it's true.
They are doing hotel,
Yeah.
they have banks, they are into transport, they are into farming. Angela,
Yeah, they're everywhere.
for you to be successful,
Yeah.
you have to have multiple sources of income. Even as who are employed, we get into boards. You are employed, but you are also giving your services to boards. You are doing financial management trainings so that you can have multiple, or you can have some passive income. If you can be able to be saving a part of your salary every month and you put it into the money market, the passive income you gain from that is an extra revenue stream.
Yeah.
So this is what the small businesses should be looking towards. Don't just be having that one business and you're stuck to it. You don't want to do anything else. That is the difference between the large companies. Look at Safaricom. Safaricom is into calls, into data, into MPESA.
Yeah.
And they keep innovating.
It's true.
So you cannot say that you will stick into, and we have seen such other companies being driven out of market by Safaricom because they were not as innovative. They did not see the market needed this and the other. So it is paramount for small businesses and even for individuals. These concepts cut across. It only that it is on a higher magnitude when it's a big company for billionaires, and it goes into smaller scales when it goes down. So it doesn't exclude anyone, even us who earn a salary. You must find ways of tracking. And when I said save a percentage of your salary, it is because you had a budget that tells you, if I'm earning this, I'm paying rent this, my transport is this, my daily operation, lunch and all this is this much. If I can be able to save this amount and stick to it, discipline.
Yeah.
Discipline and consistency. It will get you somewhere. But if you don't track your expenses, you don't want to be innovative, you'll be driven out of the market. And your statistics were very right. You said almost 83% of small businesses die within 1 to 3 years.
Yeah.
Because probably they did not put the reserves I talked about. You just got a loan, or you went into a chama and you said nipatieni mkopo. You went to put a salon somewhere, and the loan you are given only bought the equipment. Now here there is rent. Month 1, ladies are still not coming for your services. Month 2, they are coming moja, but the rent is fixed.
Yeah. It's not changing.
We said you're supposed to be paying your salary. When the customers are not coming, how are you surviving?
Are you paying the client?
So if you did not plan when you're starting that business, chances are you get into more debt burdens, because if you do not have money to pay rent, you start asking Mary, niokole 5,000 I pay rent for this business. Itakurudishia. So even when the business starts making money, there is a lot of backlog you need to clear. So this business will still go on struggling. So it is paramount, whether you're employed, whether you're starting a business, whether your business is already doing well. If it is already doing well, you put reserves aside. If you are starting, you must have reserves to take you 3 to 6 months before you start stabilizing in that business. So big businesses are telling us discipline. And discipline comes with budget, forecast your cash flows, use systems, financial management systems. Do them in your small scale. If you cannot afford a financial management system, use spreadsheet, Excel. Have this side is money in, this side is money out. Track every day, even your sales. If you record a sale every day, look at how long this sale is staying before it converts into cash. Use the strategy I told you. Be faster to invoice. When you sell, invoice. Follow up. If you want to convert this your sales very quickly, give discounts. or tell people pay me 50% upon delivery, so that you have shorter period to collect the other balance.
Yeah.
But if you're caught into this milieu of I'm making sales, you're into business of making sales, so watu wanakuja wanakopa, so to you, you are very happy that my sales
Zinaenda,
ziko juu. But when we look at your bank, cash inaenda ikireduce. There is no cash. Your liabilities, your bills fall due, you're not able to pay. Salaries fall due, you pay your employees on 10th, 15th. But the employees are telling you, but we have been doing, the sales are very good.
Sales, yeah.
But who is following up on the sales? Yeah. So you need to be very strategic. Even as you have these sales, make sure you have another team or yourself tracking how those sales are being converted into cash. So the big companies are teaching us discipline in terms of forecasting, budgeting, tracking expenses, leveraging on technology. You cannot you cannot you cannot.
And there are terms that you have mentioned, kuna vitu zetu tumerudia sana, the cash reserves, and billionaires like Warren Buffett alikuwa anasema that the cash reserves, they help businesses, they protect businesses against uncertainties. Can you agree with that?
Yes, I agree. You know, when they put these reserves aside, you see, reserves is pesa umeweka kando, you have reserved it. For our viewers to understand. So you make your sales, you convert those sales into cash, you pay your bills, there is this money remaining, you put aside that money. And that money, instead of making it lie idle, you can invest that money in short-term investment plans, so that when you know that risk materializes or that crisis materializes. For example, before COVID, those people who had reserves and COVID hit, they had some money to cushion them before they come up with more strategies on how to adapt into that situation. So cash reserves are meant to cushion you against such risks. Yes.
And there's another term that you also mentioned, that is forecasting, financial forecasting. Can you help us understand, for a business that is a startup, how does that work for them?
Yeah, if you're a startup, forecasting, I mentioned two things. There's budgeting and there's cash flow forecasting.
Yes.
Cash flow forecasting is studying your environment where you work in and know when you expect money.
Okay.
For example, if you are owning a school, you can forecast your cash flow that every time the schools open, I get more money. So even if you are going to take credit supplies, you know, for a school, maybe you need maize to feed these children. And from wherever you buy from, maybe they sell to you on credit. You can be able to tell them, give me good payment plan that I will be able to pay for these supplies at the beginning of the term. Because if they supply you when the school are closed like now, and your cash flow projection tells you hii miezi mbili hakuna revenue inakuja because shule zimefungwa, you don't expect any parent paying. So if you had planned to pay a loan you took in November and December, you must use your cash flow projection for the previous term when you received more revenue in terms of school fees. So for November and December, you can prepay it. You can discharge that loan in those months that you received the school fees. So this cash flow projection or forecasting is to help you know, when do I get money? And then how do I plan for that money? If you are employed, your cash flow forecasting tells you every month you get a salary.
Yeah.
But for those in business, they will tell you, there is this season, we are down. Those people will rely on contracts for county government, like I told you. Between July and September, they know the system is closed. So that the financial statements of the whole government and the national government can be prepared.
Yeah.
So you do not expect to get any money, and you have staffs. So when you're projecting your cash flow, it tells you, when we are closing the year in June, if I get paid by the government, that is the money that will cushion me for the next 3 months, paying salaries, paying utility bills, and even paying any other, if you had an investment loan you took, that is the money that should be paying. So this cash flow is telling you ni wakati gani mimi hupata pesa. Na hiyo pesa ikikuja, I have obligation that wakati sipati pesa, I have obligations that I have to meet. So I look at when I have money, then I plan it for when I will not have money, how I will be able to foot my bills. Yeah, so it is very critical to have that cash flow forecasting, because you know the environment you are working in. Even the saloon that I keep telling you about, there are people who make very good money when it is either Christmas or when kids are going back to school.
Yeah.
So if you don't forecast that watoto wakirudi shule I'll make better, you know, sales in terms of offering services, wakati pesa hazitakuwa, you will run into a crisis because you did not forecast that that month sipatangi pesa. So that when ninapata, ninaeka enough money to cushion me for those months. Otherwise, if you don't do that, you will be thinking you got a boom. Then
That's
you
true.
spend haphazardly that money. Then before you know it, your season for not having cash is here. So what again do you do? It's either you fall back into more debts to be able to
taking a
sustain
loan.
your obligation.
Yeah.
Yes.
And that's really wise. There's something also that you mentioned, that every business is supposed to have that is multiple streams of income. And now this may question, having multiple streams of income, does that call for different accounts to hold this money?
Of course, no, but it depends with the size of a business. For example, if we are talking like Safaricom, or their services are managed by Safaricom, you do not have an account for MPESA, you do not have an account for calls or data. When they are reporting, they just report that in this stream, which is data, we made this amount of revenue. In calls, we made this amount of revenue. In MPESA, we made this amount of revenue. But if it is a bank that has different branches in different countries, for example, you'll find KCBs in Kenya, KCBs in Uganda. You find KCB in Uganda prepares its financial statements separately from KCB in Kenya. But for large multinationals, like we have talked of company owned by Elon Musk, it would be prudent if a business stands on its own, because they are distinct in the way they operate. You see, for Safaricom is more techno, because it's like they are using the same infrastructure to give their services. But if Elon Musk is into the space, that is a different business altogether. Even the tax treatment, everything is different. Now he's into Starlink. That is a different model business altogether. It has its tax requirement, the duration requirement is totally different. So that would run on its own and having its own way of accounting for their finances. But if it is an individual like me and you, and we are saving to get a passive income with money market, of course that is also a stream that will come differently from your salary, because you are under a payroll in Mizpah, but your another passive income is coming from MMF. So there will be two different revenue streams and coming into your account differently. Yes.
And I believe that our viewers have taken note of that. And now, because we have only 4 minutes, let's talk about that is the practical solutions and the recommendations that you can give to the entrepreneurs and to the today person. And what are the first steps that an entrepreneur should take to strengthen that is their cash flow system from an audit standpoint?
I would say in audit we say what was not documented was not done. So the first thing is record.
Okay.
Even if you do not have those sophisticated financial management system, just go into your computer, open an Excel spreadsheet, record your sales, record your cash as it's coming in, record your expenses, so that at the end of the day you can track what came in and how it was spent. So for me as an auditor, if I come into your company and you never recorded, I would say it was never done. So for those small entrepreneurs, record. Because that will also give you discipline. When you record, you are able to track.
Okay.
You will see, this is how my business behaves in certain times. This is how my cash flow behaves. These are the customers I sold to on credit that take more than 90 days to pay me. So in the next cycle, if you are going to supply them, that is where now you apply strategies of making sure either they pay you half of what you are supplying to them, and then you follow up on the other half, or you give them discounts.
Okay.
Give them discounts so that you can invoice them as quickly as possible and convert that into cash. So basically it's about tracking and strategies like, you know, making sure you are invoicing very quickly, like I said, and take time to pay your suppliers so that you can free up that cash that can be used to generate more cash or revenue for you as you wait to pay your suppliers. Yes.
And even I think that also applied for the day-to-day people who are employed. They should also keep records.
Definitely. You must be able to keep your records. That's why I said every month, and I think the last time I was here, we even tackled savings. You must be able to track your expenses, even if you are employed. You must have a budget that I earn 100,000. This is the amount of rent I pay. This is the amount of food we buy in this house. So if you don't document what you do with that salary, chances are when you get the salary, you haphazardly buy things. Then date 15th, mwezi itakuwa kona kwako.
Yeah.
You start getting in those financial crises we are talking about. Kukopa, trying to fill. You open this hole, you fill it with another debt. So everybody, whether you're employed, startup, big business, record, track, and react.
Okay.
Because when you record, you see what is going on. You track, it tells you of the trends. You react by improving your strategies, adapting. Yes.
So you've said record, track, and react. Those are the three commandments when it comes to cash flow management, right?
Yes.
I believe our viewers, you've learned a lot on this segment. And Amelia, what are the cash flow mistakes that umerealize umekuwa ukifanya that is either in your business or when it comes to managing your finances? Please get to talk to us on 0799 200 100. Thank you so much for availing yourself for the show. We have really learned a lot from you, and you're looking forward to having more and more.
Thank you, Angela, for having me. It's a pleasure being here.
Yeah.
Always good to talk to our people.
Yeah.
Because if we rise together, the GDP of this country, if every one of us is informed in terms of how they manage their finances, the GDP of Kenya is a collective decisions of all of us. If all of us are making mistakes, our country will not stand. But if all of us in our small way, we are doing the right thing, even the country changes.
Wow.
Yes.
That's really powerful. Well, my name is Angela Kabeta, and we're always here every Monday. That is from 8 a.m. We give you the financial tips and strategies on how you can become a great entrepreneur, and also for the day-to-day people, make sure that you become that is financially independent in the future. Till next time, God bless you.